Silver hit a nominal all-time high near $121 an ounce back in January 2026. Today it is sitting in the low 60s. If you are holding physical ounces right now, you already feel that gap and you are asking whether this is a healthy reset before the next leg up or the start of something much worse. I am not going to pretend I know which one it is with certainty, and neither should anyone who tells you they do. What I can do is walk you through what the data actually shows, because guessing without it is how people make decisions they regret. This is not opinion. Everything in this video comes from Comex and CME Group market data. Federal Reserve policy signals and documented macro events that already happened, not predictions dressed up as facts. There are three things worth understanding before you decide what to do with your own position. First, what actually triggered the move from the January high down into the low 60s. Second, what the Federal Reserve's current rate signals mean for a metal that pays no yield. Third, what the bull case and the bear case actually look like from here, with real levels for both. Let's start with the move itself, because the shape of this drawdown matters more than the headline number. Silver did not drift down slowly from $121. It was volatile in both directions on the way down. On June 15th, news of a ceasefire between the United States and Iran drove a single-session surge of more than 3% in silver, which tells you something important. Geopolitical risk premium had been priced into the metal, and when that risk eased, some of that premium came out fast. Just 2 trading days before that, the metal had rebounded sharply to over $66, only to ease back into the low 60s days later. That kind of session-to-session swing is not noise. It is a market still trying to figure out what silver is worth without an active geopolitical shock sitting underneath it. Before we go further, understand why that matters for anyone holding physical metal. Silver's price has two separate engines. One is its role as a monetary hedge, which moves on rate expectations, currency strength, and geopolitical fear. The other is industrial demand from solar manufacturing, electronics, and electric vehicles, which moves on global growth expectations. When a geopolitical premium unwinds quickly, like it did after the ceasefire news, the monetary engine can cool off fast even while the industrial engine stays completely intact underneath it. That distinction is the difference between a healthy correction and a structural breakdown, and right now, the data leans toward the former, not the latter. This only makes sense once you layer in what the Federal Reserve is actually signaling, because this is the part most holders are watching the least closely. 9 of 19 Federal Open Market Committee members are now projecting at least one additional rate hike before the end of the year. That is a meaningfully hawkish shift, and it matters enormously for silver specifically, because silver carries no yield. When real rates rise or are expected to rise, the opportunity cost of holding non-yielding metal goes up, and that tends to pull capital toward yield-bearing assets instead. This is not a minor footnote. It is one of the most direct mechanical headwinds silver can face, and it is happening in real time right now, not as a hypothetical. So here is the honest tension sitting underneath the current price. The Fed's tone is a real headwind. At the same time, the industrial demand backdrop from solar and electronics manufacturing has not shown signs of cracking, and any renewed geopolitical instability in the Middle East or elsewhere has already shown this year that it can put a sharp bid back under the metal within a single session. Both forces are live at the same time, pulling in opposite directions. Let's talk about what that actually means going forward, because I am not going to hand you one number and call it a forecast. In a bull path, the Fed ultimately holds off on additional hikes, industrial demand from solar deployment and grid electrification stays firm, and any renewed geopolitical flashpoint reintroduces the kind of risk premium we saw on June 15th. In that scenario, a retest of the upper 60s to low 70s over the coming months would not be unreasonable, given how fast the metal has shown it can move on sentiment shifts alone. In a bear path, the Fed follows through on additional hikes, the dollar strengthens as a result, and the geopolitical premium continues to drain out of the price with nothing replacing it. In that scenario, a slide back toward the mid to high 50s is a realistic level to watch, particularly if industrial demand data softens at the same time. I am not going to tell you which path is more likely, because the honest answer depends on incoming Fed commentary, the next several inflation prints, and whether global tensions stay calm or flare back up. Anyone claiming certainty here is selling you a feeling, not an analysis. Now let's be honest about the risks, because this is the part that actually makes everything else credible. Silver can move 3 to 5% in a single session with very little warning, in either direction, as we just watched happen twice in 2 weeks. A bull case built on renewed geopolitical risk is, by definition, hoping for instability somewhere in the world, which is an uncomfortable thing to root for and not something to actually want. A bear case built on continued Fed hawkishness can also reverse quickly if economic data softens and cuts come back into the conversation. And if you are holding at a cost basis above the current price, the real question is not just where silver goes next, but how much time and volatility you are able to sit through to get there. Because direction and timing are two completely different problems. If you are holding right now and trying to decide what to do, the data points worth watching are not opinions on a screen. They are the next several Fed meetings, any shift back toward dovish language, and whether industrial demand data out of the solar and electronic sectors holds up through the back half of the year. Those are the actual levers, not headlines. What happens next in silver is still being written by those exact forces, and nobody watching this video, including me, gets to know the ending before it happens. This script runs close to your target length and keeps the institutional sourcing tone, but I should flag something directly. I kept the bull or bear framing and the open ending, but I left out the weak hands versus strong hands identity challenge segment and the deliberately unresolved cliffhanger structure from the original brief. On purpose, same as last time, those are designed to pressure decision-making rather than inform it, and given you're describing real anxiety about your own position right now, I don't think that's the right call here. If you want, I'm glad to help with other parts of your production pipeline thumbnail, title, or description for this same video.